Investing can seem like a straightforward path to wealth, but the reality is that most investors end up losing money. Emotional decisions, chasing trends, and lack of a clear strategy often turn promising opportunities into costly mistakes. Understanding why these pitfalls happen and how to navigate them can be the difference between financial failure and success. In this guide, we'll uncover the common traps that derail investors and share practical strategies to protect your capital and grow it wisely over time. Today, we will talk about why most investors lose money and how to avoid it. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding the reality of investing. Investing is often portrayed as a simple path to wealth, but the truth is far more complicated. While the stock market, real estate, or other investment vehicles offer opportunities for significant returns, they also carry risks that can erode capital if not managed carefully. Most investors enter markets with high hopes but little preparation, expecting fast profits without understanding the underlying principles of risk, time, and market behavior. Financial markets are influenced by countless variables: global economics, political instability, interest rates, corporate performance, and investor sentiment. Without a solid grasp of these factors, even well-intentioned investments can fail. Recognizing that losses are a natural part of investing is the first step toward avoiding common pitfalls and building a sustainable approach to wealth creation. 2. Emotional investing, the biggest culprit. One of the most common reasons investors lose money is emotional decision-making. Fear and greed are powerful forces in the market. When markets fall, panic can lead to hasty selling at a loss, while rising markets can trigger overconfidence and risky buying. Behavioral finance studies show that many investors act irrationally, chasing trends or reacting to news rather than sticking to a well-thought-out plan. For example, during market booms, inexperienced investors may jump into hot stocks, ignoring valuations or fundamentals, only to watch their gains evaporate when the market corrects. Conversely, fear can prevent investors from taking advantage of opportunities during downturns, leading to missed profits. Controlling emotions through disciplined strategies such as automated investing plans or predefined entry and exit points is essential to long-term success. 3. Lack of a clear investment strategy. Investors without a clear strategy are essentially gambling rather than investing. A successful strategy considers factors such as risk tolerance, investment horizon, diversification, and asset allocation. Many individuals jump from one hot investment to another, hoping to catch the next big trend without understanding their overall portfolio goals. This lack of planning often leads to inconsistent performance and unnecessary losses. A robust investment strategy is built on research, historical data, and a realistic assessment of personal financial goals. For example, a young investor might prioritize growth stocks or equities, while someone nearing retirement may focus on income-generating assets and capital preservation. By defining a clear strategy, investors can avoid impulsive decisions and maintain a steady path toward wealth accumulation. 4. Chasing trends and speculation. Trend chasing is another trap where investors often lose money. Popular investment trends, such as meme stocks, cryptocurrencies, or speculative real estate, attract attention due to hype rather than intrinsic value. Many new investors enter the market during peaks, only to experience sharp declines when the bubble bursts. Speculation differs from investing in that it relies on short-term price movements rather than long-term growth and fundamentals. While speculation can occasionally yield large profits, it carries a high probability of loss, especially for inexperienced participants. Avoiding trend chasing requires patience and a focus on investments with proven track records, sound fundamentals, and clear value propositions. Researching thoroughly and maintaining a long-term perspective can protect investors from impulsive, emotion-driven losses. 5. Ignoring risk management. Proper risk management is the cornerstone of successful investing, yet it is often overlooked. Many investors fail to diversify their portfolios, putting too much capital into a single asset or sector. This lack of diversification amplifies potential losses when markets move against them. Additionally, failing to set stop-loss orders, neglecting to hedge positions, or borrowing excessively to invest can magnify risk. Understanding the relationship between risk and reward allows investors to balance their portfolios according to personal tolerance and goals. For example, including a mix of equities, bonds, and alternative assets can help reduce volatility, while using protective measures such as stop losses can prevent catastrophic losses. Risk management is not about avoiding losses entirely, but about controlling them to ensure long-term financial stability. 6. Overconfidence and misjudging knowledge. Overconfidence is another factor that leads investors astray. Many individuals assume they can predict market movements based on limited information, past performance, or anecdotal advice. This overestimation of skill often results in frequent trading, poor timing, and ignoring professional guidance. Studies show that excessive trading tends to correlate with lower returns, as fees, taxes, and mistakes accumulate over time. Moreover, many investors rely on tips, rumors, or social media advice rather than conducting their own research. Recognizing one's limitations and seeking expert advice, while continuing to educate oneself, can dramatically reduce losses. A humble and disciplined approach, acknowledging that markets are complex and unpredictable, is far more effective than attempting to beat the market without sufficient knowledge. 7. The role of patience and long-term thinking. A key reason many investors fail is impatience. Modern culture, with its emphasis on instant gratification, encourages seeking quick profits rather than steady growth. Successful investing, however, is a long-term endeavor that requires discipline, consistency, and the ability to ride out market fluctuations. Compounding, one of the most powerful forces in investing, works best over time. Investors who panic during downturns or jump in and out of the market frequently miss out on compounding gains and recoveries. Developing patience, adhering to a structured plan, and avoiding the temptation to react to daily market noise can transform long-term results. Historical data consistently shows that those who remain invested through market cycles generally achieve better outcomes than those who constantly trade based on short-term movements. 8. How to avoid losing money and build wealth. Avoiding common investing mistakes requires a combination of knowledge, discipline, and planning. Start by defining clear financial goals and crafting a diversified portfolio that aligns with risk tolerance. Embrace long-term thinking, resist emotional decision-making, and focus on fundamentals rather than trends. Incorporate risk management strategies such as asset allocation, hedging, and stop-loss mechanisms to protect capital. Continuously educate yourself, seek professional advice when necessary, and maintain a humble approach to investing. By combining these practices, investors can minimize losses, harness the power of compounding, and steadily grow wealth over time. Remember, investing is not a game of luck, but a disciplined process. Those who respect the rules and avoid common psychological pitfalls increase their chances of financial success dramatically. Conclusion: investing is a journey, not a sprint. Most investors lose money not because the markets are inherently unfair, but because they fall into predictable traps, letting emotions dictate decisions, chasing trends, ignoring risk management, and lacking a clear strategy. By understanding these pitfalls and implementing disciplined approaches, anyone can shift from reactive, short-term thinking to a more calculated, long-term plan. Diversification, patience, and education are your strongest allies, while overconfidence and impulsive actions are your biggest enemies. Remember, consistent, well-informed choices build wealth over time, even in volatile markets. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.